Good evening, everybody. It's Ken at Tortoise Capital with the Sunday Night Strategy podcast for April 5th, 2020. We're going to take a slightly different detour tonight. We're going to do a couple things that are geared more towards the longer term posturing. And the reason for that is a couple things. There were a couple questions asked of me. Bob Rourke has shared some longer term charts from his perspective, and he and I do a coffee talk every day, and we talk about short, medium, and long-term investing and psychology and staying prepared. He's up in the mountains in Colorado managing money, and we're pretty simpatico when it comes to independence of thought, and so we use each other as critical thinking partners. And so he sent me some charts that I want to just kind of flip through so you can think along with us how we're thinking. I also want to address this note from Dave, who is a great healthcare professional and who's out there on the front lines in this fight. And I just got so much respect for him and all the folks that are in that, doing that for us. So I'm going to be talking about some of those things as well. Like, for instance, what are some of the critical thinking skills and critical trading skills that I think are absolutely essential? And I've always stressed the 2R battle drill, for example. My short answer is going to be the ecosystem view. I'm going to show a graphic on that. We got about a 30 or 40 minute discussion on it in a couple of different courses on Talent LMS in the boot camp. And I actually covered a piece of it, I think, last week in one of the nightly podcasts. So it's really central to how I take an ecosystem view of the world and of the system that we use to make decisions, the system that we use to analyze, and the system that we use to assess, so kind of getting the systems approach. I've also am going to refer to the 37 strategies document. So this is from a posting on Patreon. So all these graphics that I'm going to show you tonight are available as downloads already on Patreon, including that 37 strategies document. So that started off as a project last year where I just did kind of a speed run on what I thought were the most important topics to cover as part of taking a boot camp orientation. Like, we've accumulated so many ideas and systems that if you've been on this trip from the beginning, you already have a context built out and you already have these ideas placed in a certain way. But for new folks coming on board, I've just felt it was long overdue to have sort of a speed run from the start of getting back to basics. And so that was the motivation for the boot camp series. Well, the top 10 became the top 36 or 37, which reminded me of the supplement to the Chinese Art of War by Sun Tzu. And so the 36 strategies is a document that takes Sun Tzu's principles of war and then elaborates on it to the next layer of detail. That's like if Sun Tzu is on strategy, which he is. The 36 strategies is a military classic that talks about the operational level. How do you turn strategic guidance and intent and posture into effective action today, tomorrow, and next week? That's the tactics. So the middleware in between that strategy and tactics is what we call operations. So how do you connect ends, ways, and means? How do you go from beautiful sounding words on a page into telling the guys what to do tomorrow? Which is the tactics. Tactics is all about well-trained, well-prepared, battle drill, ruthless execution, violence of action, controlled fury, self-protection, and self-discipline. But that furious activity can lose sight of the bigger picture. So how do you maintain those tactical actions inside a larger context? Well, operations is how we make that connection. It's the middleware between where we want to go ultimately, strategy, and what we're doing today and tomorrow to win and survive, tactics. So operations is that middleware. That seems to be my particular skill when it comes into military work. I understand strategy, but just about any good strategy will have plausible deniability. A leader will have done his job when everything that happens, he warns you that was going to happen in his strategy. Like, yeah, I should have thought of that. So, and then in tactics, those guys are getting the job done, but we need to keep them focused on the right thing. So operations is how we arrange things in time and space. Well, when you think about the way we do core and turbo, whether that's monthly, weekly, daily, or daily, hourly, minute, there's always a larger strategic setting. There's a tactical decision making, and then operations is that frame of referencing that connects those things. So the 37 strategies document then is what I think are those top level cognitive skills and processes that give you a complete picture of what the tortoise methods are all about. The boot camp videos then are the next layer of detail, the articulation of those in a live setting with questions and answers that I think maybe makes some of those words come alive. So all three of those things taken together, in my view, answer Dave's question so far. But really, it's which of those resonate with you, which ones are important, which things are you not clear on, and then hopefully this continuous dialogue we have through this medium and others is a way to continue to bring our thinking from our belly to our head so we can discuss and work on it and sort it all out. So all of the documents there on Patreon are going to be some of the visuals that I go through here in a minute, and you can look at the 37 strategies. So on the Talent LMS, I'm building out, have already built out the boot camp course on Talent, so it's a little easier to access. And I'm building out the 37 strategies pretty soon. This little package right here, the ecosystem view, the 37 strategies, the boot camp, those are kind of the basic training that I'm preparing for folks who are attending the Van Tharp Institute workshop I'm doing in June, which is going to be a streaming workshop. It's called Advanced Hybrid Trading. And all we're going to do in that course is what we're doing here every night, every day, all week, each month, that synergy of the strategy, operations, and tactics. And those three sets right there, the ecosystem view, the 37 strategies, boot camp, and probably the introduction I just made is going to be part of the basic training that they're going to get. And then in that course, they'll be playing along with us, and then they're going to submit their questions to me for further answers by 1 June. And then I'm going to cut off their questions at 1 June and then take a week to prepare thoughtful answers, particularly for their use. And then we'll live stream those answers to them June 7 and 8. But it's of a type of what we're doing here, kind of the same thing. So I thought I'd put that into perspective for you. So ecosystem, 37 strategies, and the boot camp videos. So I'm going to come back to those here in a little bit, but I wanted you to hear where I'm going to end up. I want to get into Bob's slides so we can kind of shift directly to a quick assessment of some market opportunities and whatnot. And Kim, you sent me a question too about what ETFs would I look at to take advantage of downside price action if you couldn't go short. Let me ask you, reply over there in the comment box. If Can you go long inverse ETFs like SDAO, as an example, in your if you can. Oh, if you can do SDAO, then that's all you need, honest to goodness, because if the market is going down, then all the correlations are consolidating and everything's going down together. And the thing that everybody's worried about right now is the whole world. And the whole world, most efficiently expressed, resides in the hope that we have that the large caps are going to survive. And so the best expression of that is the Dow 30. So if there was genuine fear, that fear would be manifest in the Dow Jones 30s going down. Well, the way to play that on the inverse would be the SDAO. What you'll see is that put all of the, you just asked me about VXX and UVXY and TVXY, or TVX. TVIX is the double. You'll see that there's very little difference between them and SDAO. But the advantage of SDAO is that it's actually anchored to 30 genuine components of the Dow 30, whereas the volatility ETFs tend to be more volatile intraday because it's really just being expressed in the psychological posture of people playing options and futures on the index. So there is a certain granularity or grounding, if you will, of SDAO in something that's really tangible. The other opportunity there is in let's see, the triple S&P inverse, SPLX. I think it's SPLX. But there's not much difference between that and SDAO. If everything is going down, then either one of those is going to be massively good. And in terms of tactical trading, any of those is fine. I just prefer SDAO and UDAO because I like the sense that it's anchored in the large caps. Okay, so having said that, let me shift over to some of Bob's charts and whatnot. So Bob and I are inveterate readers of things like, whatever, news and opinion makers and all that other stuff. And here's a guy that was at Barron's talking about who's going to win. Well, data center stocks could be the winners as the internet usage soars. So there's a whole bunch of ideas chunked into there. Well, that's nothing different than what I did last week, where I talked about my thoughts about the rebuilding of the U.S. infrastructure and bringing the jobs home. And so as a result of that, I put together a number of symbols into an infrastructure portfolio, right? And that one already had some payoff when we looked at, let's see, where was it? Personal infrastructure, candlestick. So this is the one on as a result of so here's where this infrastructure list came from, and this is about strategy and mindset. So I had that idea, and so I was able to use TC2000 to do the following. I was interested in I was going to make a new personal list, but what I was able to do was come down to industry indexes and sectors, and then quickly find through TC2000 a bunch of different symbols that I was interested in. And so Vulcan Materials came up as part of that, right? Well, I built out a bunch of symbols that were in that. So things like Alcoa, Boeing, Caterpillar, Cliff Natural Resources, the Dow 30 itself as a reference, Ford, Freeport and Rand, IAA, Martin Marietta, Nucor Steel, And so it turned out that when I put that together and was trading, this turned out to be something like a 20R on Friday, and I went through that in the Friday's podcast in Vulcan Material. But the point of this is that when you have certain ideas about what things might work or not, I find it pretty efficient to just gather that list of companies that are affected, dump them into the framework here, and then use the standard sense-making ecosystem of the tortoise approach to put things into proper perspective. So when I was trading the other day on Friday with this, it was pretty quick to say, hey, the Parsley Energy ended up being a beautiful trade intraday. Look at the almost a V bottom intraday, down and up. Boeing was interesting. Had some tradable movements. But Vulcan Material was the one that I just ended up staying with all day because it never really recovered until late in the afternoon. And now you see you can see the power of that VWAP magnet happening right here, that after it bottoms out and then in the last hour of the day, what does it do? It runs back from that low of the day all the way back to the VWAP, just like a Swiss watch. But in this other section, the downward move, starting with a hybrid frog entry, that whole move was available just by following the rules, and it was something like 20R. Well, that's the basic principle that Bob and I are kind of following when we do something like this, where we're just sniffing around and looking at what who is going to make the gains in the short term, medium term, and long term, if you believe, as we do, that we're looking at a fundamental restructuring of the economy and the psychology that's going to last a generation. You know, if you think about the Great Depression and the end of the Roaring '20s and the Great Depression, that ended up with structural changes in the U.S. economy and government and social policy, like the New Deal. Go after that is by going through here and coming up with some ideas and then putting them into a watch list and then building out a long-term approach or a long-term lens that allows you to address those things. Like Amazon is a really attractive idea here because they have a nexus of the entire supply chain system. They have Walmart's buying power, but they also have financial services, web services, which is where they earn at least half their money, is by selling excess capacity in a business-to-business e-commerce solution to everybody. And they're getting into the delivery business and the brick-and-mortar business with their regional distribution centers. So they've kind of quietly become the dominant player to compete with Walmart in the end-to-end supply chain. So there's no scenario in which they're not going to be an important player, and so understanding where they are in the ebb and flow of things is going to be central to any strategy for the next 1 to 20 years or the next 1 to 10 days. So Amazon has to be on your list. Microsoft in the same way, in the sense that they're building out the cognitive infrastructure for enabling the IT solutions that are being used by 90% of the world, except for the guys who just love Apple. So that's why I want to bring this up, is that in the same way that I put together that infrastructure watch list and lens, I want you to think about that as a systematic lens for looking at the world and looking to see how that idea unfolds in the weeks and months and years ahead. This article was another way to look at it from the IT perspective, and it's through the lens of Barron's and their analysts over there. So by the same token, that sent Bob off on a little journey through through Chartland, and so we're going to just take a look at some of the things that he finds interesting. And my general rule of thumb is that when Bob Rourke tells me he finds something interesting, I'm automatically interested. I don't have to go past rule number one. That's when Bob's interested in it, I'm interested in it. So he's looking here at the Dow 30 Industrials, and now we're looking at monthly charts, and going back to the year 2000. And so there have been 3 existential threats in the last 25 years. One of them was the internet bubble bursting and then bottoming out here on March 9th, 2003. March 9th, 2003. That was the washout pattern. When you look at my market health check on that day, that's what we said. Hey, this is a washout pattern. Some people will call this the bottom. Others, who knows? But that's what the washout pattern was. And then for the next, from 2003 until 2008, there was an extraordinary opportunity, a 5-year recovery from what looked at the time like the end of the world. It always does, right? And so what he noticed here was that the in the RSI 10, where it started to break out back above this 34 number, coincided with a crossover in the he uses a 430 MACD histogram on the longer terms with a 5-period exponential. It's the same principle that I use on my 4 seasons. I just stay with 10 and 30 because I'm lazy. But the 430 moves a little quicker at the turning points. And so I just want you to notice what happens here when you look up at price. There's just an unended, that's the start point of what was a 5-year brilliant move. The next one was the meltdown in 2008 and 2009, and that resulted in this extraordinary move to the downside in RSI 10 on the monthly, followed by almost a 200% return from the peak low to the peak high of this up to here in the Trump boom. So that turning point was pretty smoothly called by just studying the Dow Jones Industrial 30s on a monthly charts using our 4 seasons of the MACD. And again, as you interpret this, when it crosses that 0 line, winter and special rules apply. But when it bottoms out and then crosses over its slow moving average, and then you can start the way Bob beautifully draws the his Bollinger Bands with these increments. Each one of those is like a little signpost of when it's getting better and getting better and getting better as you come through the spring and then back into the summer. Now, the thing I want you to notice is that when you have a summer, fall, summer, that's an amazingly powerful signal. That was true here. It was true in each of these locations. It was here. It was true here in the Trump presidency. The surprise, the shock to the nation of 2016 was the beginning of an extraordinary move. In the same way that in the 2003 to 2005 run-up, every one of these where it goes summer, fall, and then resumes the summer, it doesn't fail further. That's incredibly important in a strategic time setting for end-of-day traders. So that's the clot. We're closer to the beginning than the end of the real impact on the large caps. And so even though this looks like a bottoming tail, the fact that it's we're going to see in another chart here in a minute why that's just leg one. Don't know that that's going to be a bottoming tail, but the fact that it came all the way back to this long-term moving average is putting the entire enterprise at risk. And so the long-term support level, if this fails, is back here at the red line, which is the stable, the 200 period moving average of the monthly. That's the 200 monthly moving average, right? So in terms of this, I think so. Digital Realty, this is one where Bob would be interested in it because it's held up pretty well. It had a nice big recovery move already and has only pulled back a slight distance. So Digital Realty is a real estate guy who's going to be well positioned in the great exchange of mortgages for people that are going to get screwed by failure of the nation to support them in their times of need. Guys like realtors that are postured are going to benefit from that. So Digital Realty is somebody that could be on our list. National Beverage Corp. They've already made the turn, you'll notice here, and have bottomed out on the daily and getting ready to do a PSAR flip, and that's increased sales of beverages at home and being able to deliver them direct to your door. So Fizz, National Beverage Corp, defensive sector. I mean, what else is there? I mean, I might as well drink fizzy drinks at home. Hormel Foods, got to have that spam and supplies. They've already had one surge, a pullback, and a surge. So this is the summer already. And they're already postured for great success. And at $48 a share and near an all-time high, it's a steal. And how are they going to go wrong for the next 5 years? You could buy them and go to sleep, Rip Van Winkle on that one. HRL Hormel. Kraft, same thing. They have bottomed out. This is just the first leg up, but you're getting them early. They were at 90 in 2017 and have sold off to 25. You're buying an option on them, and they're already in the green. It's going to PSAR flip here pretty soon. Kraft. Feel how relaxed this is on monthly charts. But I want you to also notice that it's the same decision making, the same frame of reference, the same interpretation, and that's what you get from the fractal nature of the sense-making framework that is the Tortoise RLCO, Bollinger Band, MACD histogram lens. 10-year treasuries, this is an extraordinary change in the last 8 years, so we're still on monthlies now. The last time that it was down in this territory, when it crossed back over, here was a false start, and here was the big follow through, followed by and there was a PSAR flip. So if this were to change, this is at $6, and the return to normal is at 20. That's a potential for a 300% return, and if that's a bottoming tail and this thing turns, to me, buying it at 6 with a $2 stop, you're buying an option on it. Why not? That's the 10-year yield. The 30-year yield. Oops, I skipped. Sorry, skip one. The 30-year yield looks exactly the same. And then his highlights here are showing that when you get this rollover period at the top, rollover periods at the top of a move, those are significant, and that's sort of the upper limit. Right here is when it's at 30. So this is from 12 to 30. The other one was 6 to 30. So that's your reasonable upside limit over the next months and quarters. UDOW. So now we're still looking at monthlies, and now I want you to notice the power. This is the triple leveraged Dow. So during a period of spring, fall, and then summer, fall, summer, right here. And now look at this run from basically $2 to 30, 1,500%. Are there long calls on UDOW? He asks. Yes, there are. And notice how that ribbon-shaped Bollinger Band on the MACD histogram gives you incremental guideposts that says, yep, it's good to go. And by the time it crosses the Red River, you're free and clear. with opportunities to add every time that line starts getting steeper. And now these become the different seasons of the witch right here. And now the world has changed. But what we're really interested in is when that winter becomes spring, and then we start seeing this yellow line crossing the segments of the Red River. Bob asked me, are we the only guys seeing this? Apparently so, because I haven't seen anyone else talk about this in this way. But so here's the value line geometric index. That's another measure of broad equity opportunities. And again, you can see that long period of sideways quiet channel. When it went briefly into the winter and then resumed, you read north in a PSAR flip, you could go from 400 to 600. And now this smashing move down here, we want to see it turn just like it turned here. And when it starts becoming the spring and the PSAR flip, that'll be the time to start buying that, and not until then for the long term. That worked back here. It worked here. It worked here. It also worked in here. Those PSAR flips on the monthly, massive goodness. Asking me how to manage long-term core capital? That's how. This is Wynn Resorts, and this is that sort of the old Guppy box method, or the Darvis box, and the different chunks. Steps up, steps down, and it just broke down out of this. Now, if it rejects here like it did, this is why we're short Wynn. And this is that the recovery point is when it flips here, which is when the PSAR flipped there. Look at the size of those legs from that piece, the value of the PSAR flip. And this PSAR flip just started. So, yeah, could this be a support level? Sure. But we will have plenty of warning on when it's time to reverse, but they're not going to get well anytime soon. LTB, load the boats at these moments. Those transition points. You say, yeah, well, what about this transition point? Yeah, I would say, yeah, and that's what your stops are for. If you loaded the boat up here at 100 and you exited at the PSAR flip, you scratched. What's the trouble? None. No trouble. And when the PSAR flips and you go short, what's the trouble? None. The PSAR flip short would have been here. Short, 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 short. How much more do you need? So we'll do some more. World Gold Index is it's now later in the day rather than earlier. But again, the PSAR flip and winter, spring, summer get you in here, and off it goes. It's back to the long-term fair value. Here's the peak. Still room to go, but only about another 10%. There's a limit. Next one up is XMI Major Market Index. That's certainly the stop limit, and we'll find out if this is a bottoming tail. There's not that many times the world has faced existential threats like this with this kind of psychology and this kind of digital technology and this kind of information system that you can do any kind of statistical analysis. That would be dumb. So this is a place where craft knowledge and rules of thumb and fractal analysis makes a difference. Times to short treasuries are on the rollover points here. This was one, but then you scratched, and now it's getting pretty close. When this rolls back over, that's the time when all that money comes out of treasuries into things that are gaining. Jack Henry and Associates. So these guys are in the business of providing loan management for all the companies that are taking out loans for unemployment, benefits and salary protection so that they can keep people on payroll and not boot them off. All the small and medium cap companies that didn't get access to that pool of capital have to take out loans now to be able to keep their people on payroll. The interest on that's going to be forgiven, and maybe some of the principal, but only if they don't lay their people off. So they need a way to access that money. Jack Henry and Associates are guys who are in that business of providing B2B loan management to small and mid-cap companies. So they've already started to make the turn. Making the turn here, and as you can see, making the turn there. So an interesting play. So that's what I want to say about that. Any questions on any Bob's charts? I'm going to just kind of move on. I think it's pretty clear. But that's how Bob thinks. That's how we think about the long-term framework using these monthly charts. So this is not minute-to-minute intraday trading, but this is posturing large amounts of capital for long-term core positioning and protecting the farm. So here's one I want to talk about, if I can. Let me get to... So I sent out this note on, I think yesterday. Seems like a long time ago. But I shifted my view of the monthly chart just to take a break and try a different look. And started looking at the through the RLFF lens. And I got to tell you, I've been looking at this chart in this way for maybe 15 years. And it wasn't until yesterday that I finally saw what I was looking for. And what I've done here is taken all the price off of it and taken the Z1, 2, and 3 off of it. And all I have is the RL270. So this is monthly chart. This is the RL270. So that's the long-term fair value. The RL90 is the green line. The RL30 is the thick black, and the RL10 is the thick blue. The actual closing price of each month to month is that very, very thin black line, so you can see the leading edge or the bleeding edge of monthly price. And then the MACD 1030 in the usual way down here. And so one of the things that I do is I look to see those moments, like right here in 2013, when the RL10 equals the RL270, that's that moment when everybody in the trade agrees that the current price is fair and good to go. So the RL10 is the fast trader's price. The RL270 is the long-term buy and holders estimate of fair value on that time frame. And it doesn't matter whether we're looking at 1-minute charts or monthly charts. On that time frame, that's the difference between aggressive young fast traders and old fogies, right? On a monthly chart, the old fogies on monthly charts is the Rothschilds, the people who own the world. The fast traders are guys like aggressive young banks or something. But guys that look at their charts once a month, have that kind of financial protection. So back in 2013, there was a magic moment when they both agreed that that was the fair price over here at about 150. And in that time from 2013 onward, that's 4 years after the last existential threat and that recovery. 26. This little pullback right here on a monthly chart that's what happened when the Trump shock occurred. When it's not Hillary, it could be Trump. Well, it's Trump, and then November 2015 and 2016. This is that little 10% sell-off, and then the Trump boom from like 200, which found its way all the way to 320, with hardly one hiccup, and now this hiccup that has brought everything back to 250. The long-term fair value in that time has now climbed to 240, so that has come from 140 to 240. That's how close we are to fair value. in terms of the Rothschilds. They are looking at that as the beginnings of risky behavior, because all they're counting on is that purple line. Now I'm just putting words into their mouth. I want you to notice the 9270, that if you were the Rothschilds and you wanted to use leverage to get even more, this is like the RLCO. The fast has now crossed over the slow. The 90 has crossed over the 270. That's like a 1030 crossover on a much, much shorter time frame. But man, that if they were ever going to use leverage, it would be this one. And look what just happened. They are just starting to roll over and say, oh, maybe that was premature. Maybe we need to think about protecting the long-term fair value by unwinding all of our leverage positions now. Now, I want you to notice I want you to notice three rivers on here. The first one is kind of like it's not a river, it's really the dragon, which is the 10-period Bollinger Band on the blue line. That's the 10-period Bollinger Band. I'm going to come back to that. This middle one, this gray one, is a 30-period Bollinger Band on the fair value. That acts like a noise buffer. And that's why, to me, the aggressive Rothschilds are looking at here. The very conservative ones are here. So 200 is their line in the sand. And that's the point where if all of this disappeared, the entire Trump economy disappeared, the last fighting position is the previous support level at the belly of the dragon at 200, which coincides with the bottom of that gray river. The third river to look at is the red river that is built out of the MACD histogram. And now I want you to notice that this last little sell-off here caused the MACD histogram to go from summer into fall through the red river, and then it went summer, fall, summer, and then this was the next massive run-up from like 290 to 320, 330. And that felt great. But now suddenly, this collapse we couldn't even get all the way through the Red River. It has departed the Red River. This is a sign of extraordinary concern psychologically, as I'm interpreting it. I don't know who those guys are. I don't have privy to their brain power. All I have to do is look at the statistics of previous price action, and I'm inferring what their positions and their psychology must be. So what I'm highlighting on here are all of the different support levels that we've seen in terms of price geometry, fair value, and then I'm looking at this gray river here as the yellow zone. That's the worry of the international bankers and the sovereign wealth funds. We are right at the limit of testing this. Now, it has rebounded a little bit, but we're right on the boundary of genuine concern. Like, you don't really think that international bankers are worried about dying from the virus, do you? If there's any kind of medical treatment, who do you think already has that before the masses do? Those guys. But they're not worried about their personal health. They're actually worried about how we're going to react to this market. That's why $10 trillion from the Fed was promised, and more if needed, to keep this thing from falling any further through the real critical zone. If it doesn't fall through here but then takes off, this will be the mother of all buying opportunities, in the same way that we saw all of the opportunities on the previous charts that Bob provided us. This turns out to be the same length of time on a monthly basis for those red boxes that he showed, how long it takes for that great big iceberg to turn and shit, or the Queen Mary to turn. That's the time frame. This is the moment of decision for the global world markets. Now, so that's the three rivers, the red river, this gray river, and then this little dragon up here. Now I want to show you the thing that I've been staring at for 15 years and couldn't even see until yesterday. And this has everything to do with how to manage your long-term capital when things do get back to normal and price gets above that dragon once more. I want you to notice how powerful in normal markets the southern skin of the dragon is as a way to deal with the day-to-day fluctuation of price. If the day-to-day fluctuation of price is summarized by the RL10, which is the blue line, then the dragon is the buffer of noise. Now I want you to notice what happens when the black line of price crosses the southern skin of the dragon. Well, it doesn't in this entire move from 2013 when it left the dragon all the way up here until this moment of time. So if you use the southern skin of the dragon as a stop, warning, now you want to rebuy when price goes above the dragon. It didn't even get out until here. And then all the way up, you're protected until this warning, and it protected you against this drop, and then got you back in here, and all the way up until this point when it gets you out at 290. 290. And now it's down around 240. So the southern skin of the dragon as a support level for price on long-term positions is an amazing guide to market conditions and what your posture ought to be. I tell you, I've been staring at that chart for 15 years, and it hit me in the face like a cold, wet fish yesterday, finally. And the reason is that the simplification of the chart allowed me to focus on the essential elements and then just studying it to see what I might see. And I mean, who knows why that stuff happens, but that's what it was. Okay? So, the southern skin of the dragon on the monthly chart. And what is that price level? It is the 10-month moving average minus half a standard deviation. Because the dragon is a 10-period Bollinger Band plus or minus a half. So all you got to do is put a 10-month moving average minus a half a standard deviation, and that's your trailing stop for your long-term portfolios. I'm just telling you, that's math. And then when you see the RL10 start to move up like it did here, when it resumes, you're good to go. And it's good to go. You could even play when price crosses the 10 and the slope of the 10 is up, you're good to go. And we already knew that. But that's the early warning on monthly charts. And if all you got is a couple minutes each weekend to update that look, how much more do you really need? You don't have to read people's opinions and health checks and all that stuff. You can just focus on the math and the numbers and turn off all the noise. I'm just telling you. That's how significant that moment of Zen was for me yesterday. Yeah, that's a pretty good lesson.